For the first time in nearly 3 decades, something historic has quietly taken place in the global financial system. And strangely, almost nobody is talking about it. Central banks across the world are now holding more gold than U.S. Treasury bonds in their reserves. That moment has not happened since the mid-1990s. Think about that for a second. The institutions that manage trillions of dollars and literally control national currencies are choosing a metal that pays no interest over government debt that does. That decision says more about trust than profit. And if you understand why this shift is happening, you might understand where the global economy is heading next. For decades, the global financial system followed a predictable pattern. Countries stored their wealth mainly in U.S. Treasury bonds. Those bonds were considered the safest asset in the world. Governments trusted them because they paid interest and were backed by the United States economy. Gold still existed in reserves, but it played a smaller role compared to government debt. That system worked for more than 30 years. But recently, the numbers have started telling a different story. Central banks have slowly been reducing their treasury holdings and increasing their gold reserves. Eventually, something remarkable happened. Gold's share of global reserves climbed above the share held in U.S. Treasuries. The difference is not massive yet, but the direction of the trend is what matters. Gold is rising while treasury holdings are gradually shrinking. That shift raises an uncomfortable question. Why would financial institutions that manage national wealth prefer a metal sitting in a vault over a government bond that generates income? The answer lies in trust and long-term risk. Over the past decade, government debt around the world has grown at an unprecedented pace. In the United States alone, total national debt has surged past levels that many economists once believed impossible. Interest payments on that debt are also climbing rapidly. Every year, the government must pay enormous sums simply to service the money it has already borrowed. Foreign governments and central banks are watching these numbers closely. When a country keeps increasing its debt while continuing to print more money, confidence slowly begins to weaken. Investors start wondering whether the value of that debt will remain stable in the future. At the same time, geopolitical tensions have been rising. Trade conflicts, regional wars, and new alliances are changing the balance of power in global finance. Many nations are now exploring ways to reduce their dependence on the U.S. dollar. Gold, unlike paper assets, does not depend on any single government. It cannot be printed. It cannot be devalued through policy decisions. For thousands of years, it has acted as a store of value during periods of uncertainty. That is why many central banks are quietly shifting their strategy. They are not chasing profit, they are preparing for risk. And when institutions that control the world's monetary system start preparing for risk, it usually means they see something ahead that the public has not fully recognized yet. But the story does not stop with gold. Something else is happening in the precious metals market that might be even more unusual. While central banks are accumulating gold, the global supply of physical silver inside major exchanges is shrinking at an alarming speed. Silver inventories stored in major trading hubs have dropped dramatically in a very short period of time. Across several global exchanges, millions of ounces have disappeared from vaults in only a few months. This is not a small fluctuation. It is a synchronized decline that analysts rarely see. To understand why this matters, you have to understand how commodity markets normally work. Most trading in metals happens on paper. Investors buy futures contracts representing metal rather than taking physical delivery of the metal itself. As long as there is enough supply stored in exchange vaults, the system functions smoothly. Contracts can be settled and the market continues operating without problems. However, if large amounts of physical metals start leaving those vaults, the situation changes. When physical inventories shrink too much, the paper market begins facing pressure. Traders who want real metal may demand delivery instead of rolling over contracts. If enough people do that at the same time, exchanges can struggle to supply the metal required to fulfill those contracts. That is why the decline in silver inventories is raising eyebrows among market observers. At the same time, governments in different parts of the world are starting to discuss policies related to gold and sound money. In the United States, some state lawmakers have proposed ideas that would link certain government bonds to gold. Even though these proposals are still early and not yet law, they reveal something interesting. The conversation about tying financial instruments to physical assets is slowly returning. Put all of these developments together and a pattern begins to appear. Central banks buying gold, silver leaving exchange vaults, governments discussing asset-backed financial instruments, and geopolitical tensions creating uncertainty in energy markets. Individually, each of these trends might not seem extraordinary, but when they happen simultaneously, they start to resemble the early stages of something larger. And if history offers any guidance, similar conditions have appeared before during major economic turning points. To understand what might be unfolding today, we need to travel back more than 50 years to a moment that completely reshaped the global financial system. In 1973, the world experienced one of the most dramatic economic shocks in modern history. Oil suddenly became a geopolitical weapon. A group of major oil-producing countries decided to restrict supply to several Western nations. Almost overnight, the price of oil skyrocketed. Energy costs exploded. Gas stations ran out of fuel. Long lines of cars stretched across city blocks as people waited for hours just to fill their tanks. For the global economy, the impact was immediate and severe. Manufacturing slowed down because energy became expensive. Transportation costs surged. Businesses struggled to manage rising expenses. At the same time, inflation started spreading through every corner of the economy. Food prices rose, housing costs increased, and ordinary families felt the pressure in their daily lives. But the most interesting part of the story did not happen in gas stations or factories. It happened in financial markets. When the oil shock first hit, investors were confused. The world clearly faced a serious crisis, yet the markets did not immediately react in the way many people expected. Stock markets began sliding downward, but gold prices remained relatively calm for several weeks. Instead of exploding higher, gold traded sideways. For many investors, this created doubt. If the world was entering a period of inflation and economic instability, why wasn't gold rising immediately? Had the relationship between gold and crisis changed? Was the market ignoring the warning signs? For about 6 weeks, precious metals showed little movement, and then something shifted. Slowly at first, investors started recognizing what was really happening. The oil shock was not just a temporary supply disruption, it was triggering a deeper economic transformation. Inflation was rising rapidly, economic growth was slowing, and governments were struggling to control the situation. When markets finally understood the magnitude of the crisis, capital began moving quickly. Investors rushed toward assets that historically performed well during inflationary environments. Gold became one of the primary beneficiaries. Prices began climbing steadily, and momentum quickly accelerated. But the real explosion happened in gold mining companies. Mining stocks started rising at a pace few people had imagined. Within a relatively short period, many gold mining companies experienced massive gains. While traditional stock markets were suffering heavy losses, mining shares were moving in the opposite direction. The contrast was extraordinary. During that same time frame, the broader stock market declined dramatically. Businesses tied to the traditional economy struggled under the pressure of rising costs and weakening consumer demand. Investors holding standard equities watched their portfolios shrink. Meanwhile, those who had positioned themselves in gold-related assets experienced one of the strongest rallies of that decade. What made the difference between these two outcomes? Timing and understanding. The investors who recognized the implications of the energy crisis early had time to adjust their strategies. They understood that inflation, currency instability, and geopolitical tension often push capital toward hard assets. Those who ignored the signals remained exposed to markets that were vulnerable to economic shocks. Now fast forward to the present day. Once again, the global economy is facing an environment filled with uncertainty. Energy markets are under pressure due to geopolitical conflicts and supply disruptions. Oil routes that carry a large percentage of the world's energy supply are increasingly becoming strategic flashpoints. Whenever energy supply becomes uncertain, the ripple effects spread quickly across the entire economic system. Transportation becomes more expensive, manufacturing costs rise, food production becomes more costly. Eventually, those increased expenses are passed on to consumers in the form of higher prices. This creates inflationary pressure. At the same time, governments around the world are dealing with historically high levels of debt. Over the past decade, public spending expanded significantly in many countries. Economic crises, stimulus programs, and emergency policies all contributed to rising debt levels. Servicing that debt requires constant borrowing and continuous demand for government bonds. But what happens if global investors begin losing confidence in those bonds? That is the question many analysts are beginning to ask today. Recent data shows that central banks across multiple countries are quietly increasing their gold reserves. Instead of relying exclusively on government debt instruments, they are diversifying into assets that cannot be printed or inflated away. Gold plays a unique role in that strategy. Unlike currencies, gold is not tied to the policies of a single nation. It does not depend on interest rates or government guarantees. Its value comes from scarcity, historical trust, and global recognition. Silver plays a different but equally important role. And while gold is primarily a monetary asset, silver also functions as an industrial metal. It is used in electronics, renewable energy technology, medical equipment, and countless other applications. This dual nature means silver demand comes from both investors and manufacturers. When industrial demand remains strong while investment demand increases, supply pressures can develop quickly. Mining companies cannot instantly increase production to meet sudden spikes in demand. Developing a new mine can take years of exploration, permits, financing, and construction. Even once a mine begins operating, production levels grow gradually rather than instantly. This slow supply response creates a natural bottleneck. If demand grows faster than supply, inventories begin shrinking. And that is exactly what some observers believe is happening right now. Across several major commodity exchanges, the amount of physical silver stored in vaults has been declining steadily. Large quantities of metal have been withdrawn over relatively short periods of time. Where that silver is going is not always immediately visible. Some of it may be moving into long-term private storage. Some may be going directly to industrial users who need the metal for manufacturing. And some may be entering investment markets where buyers prefer to hold physical assets rather than paper contracts. Whatever the reason, declining inventories introduce a new layer of tension into the market. When physical supply becomes tight, the gap between paper trading and real metal availability can widen. Financial markets often continue operating normally until that tension reaches a breaking point. History shows that once markets recognize the imbalance, adjustments can happen very quickly. The energy crisis of the 1970s demonstrated how rapidly economic conditions can transform once investors understand the full scale of a situation. Today's environment is not identical to that era, but the similarities are striking enough to attract serious attention. Rising energy tensions, growing government debt, central banks increasing gold reserves, physical metal inventories shrinking, and financial markets trying to determine what all of it means. When these types of signals appear together, they often indicate that the global financial system may be entering a new phase. The question is not whether change will occur. The real question is how quickly markets will recognize it, and what happens when they do. When all the pieces are placed together, a larger picture begins to emerge. Central banks increasing their gold reserves is not just a symbolic gesture. These institutions make decisions slowly and carefully. When they alter reserve strategies, it usually reflects long-term planning rather than short-term speculation. Their growing preference for gold suggests that many policymakers want a stronger hedge against financial instability. At the same time, the declining amount of physical silver stored in exchange vaults points to tightening supply conditions. When metal leaves the system and is stored privately or used in industrial production, it becomes less available for trading markets. That can eventually influence pricing dynamics. Another factor reinforcing this trend is the growing conversation about financial systems backed by tangible assets. Some policymakers believe linking financial instruments to physical commodities could restore confidence during periods of heavy debt expansion. Although such ideas remain controversial, their presence in legislative discussions indicates that the debate over monetary stability is intensifying. Meanwhile, the global economy continues facing challenges from multiple directions. Energy supply concerns affect production costs and transportation. Inflation pressures influence consumer spending. Rising interest rates impact borrowing costs for businesses and households. All these factors interact with each other. When borrowing becomes more expensive, governments must spend more just to service existing debt. Investors begin evaluating whether traditional assets will maintain their value over long periods. That evaluation often leads them toward diversification. Historically, gold has served as one of the most reliable diversification tools during uncertain economic conditions. Silver, because of its industrial role, can experience even stronger price movements when supply and demand become imbalanced. If the current patterns continue, central banks buying gold, inventories shrinking, and geopolitical uncertainty persisting, the precious metals market could eventually react in a significant way. However, markets rarely move instantly. Just like in the 1970s energy crisis, there can be a delay between the initial shock and the full market response. During that period, prices may move sideways while investors try to understand what the new environment means. Eventually, the market reaches a moment when uncertainty turns into recognition. That is when trends become clearer and price movements accelerate. Whether the present situation will follow the same path remains uncertain, but the signals appearing today are strong enough to deserve attention. Now, the most important part of this discussion is your perspective. Financial markets are shaped by millions of individual decisions. Investors, analysts, policymakers, and everyday observers all interpret the same data differently. Some people believe the rise in gold reserves simply reflects diversification by central banks and does not signal a major shift in the global monetary system. Others see it as an early sign that confidence in traditional financial structures is slowly changing. The same debate exists around silver. Is the decline in exchange inventories just a temporary adjustment in supply chains, or could it represent the early stage of a much larger tightening in the physical market? History has shown that major financial transitions rarely happen overnight. They develop gradually, with small signals appearing long before the majority of people recognize their significance. That is why discussions like this matter. If you have been following developments in the precious metals market or global economics, share your thoughts. Do you believe the shift toward gold will continue in the coming years? Do you think silver supply pressures could eventually influence prices? Your insights and analysis add valuable perspectives to the conversation. And remember the question we started with. Why would central banks prefer gold, a metal that produces no yield, over government bonds that pay interest? The answer may ultimately reveal how institutions view the future of the global financial system. When trust in paper assets remains strong, governments can finance debt easily and markets operate with relative stability. But when that trust begins to weaken, investors often look for assets that exist outside traditional monetary structures. That is where gold historically returns to prominence. Right now, we are witnessing several developments occurring at the same time: rising geopolitical tensions, discussions about alternative financial systems, declining physical metal inventories, and central banks quietly increasing their gold reserves. Each of these trends alone might not signal a transformation. Together, they form a pattern worth paying attention to. Whether this moment becomes a turning point similar to previous historical shifts will only become clear with time. But one thing is certain. The data emerging today suggests the financial world may be entering a period of significant change. And when change begins quietly in global markets, the people who notice early are usually the ones best prepared for whatever comes next.